Hello guys, in last video we discussed about unit 1 annuity. It is very important topic which is asked in CAIIB in ABM Advanced Bank Management. In this video we are going to see about unit 2 calculation of YTM. This one also very important which is asked in BFM Bank Finance Management in CAIIB. The main objective of this unit is to see the types of bonds, characteristics of bond, and impact of change in interest rate on the bond, then duration of bond. In general, to run a company, that owner is not able to invest full fund. He can't able to invest entire amount to run the business. So you have to arrange some amount from outside. So to arrange an amount from outside, there is only two options. One is a debt and another is equity. Debt means it's a loan, getting a loan from somebody. Equity means that company shares has been sold to the public. By that, fund has been raised by the company which is utilized to run the business, which is known as IPO, initial public offer, which is well known in stock market. In case of debt instrument, whether company runs in profit or loss, that company have to pay an interest to the lender or investor, while in case of equity, only in case of company runs in profit, then company will provide dividend to the shareholders. If company is in loss, no dividend will be provided. It's the difference between debt and equity. And one more important point is that interest paid in debt instrument is tax exception. For example, the interest amount is reduced in income of the company, so it is tax exception, while in case of dividend it's not tax exception. So debt instrument has a tax exception. Debt capital provide a tax shield. From investor point of view, debt instrument is a less risky one. So debt instrument is as follows. First one is bank borrowings. So the company can take a loan from a bank and then you have to pay an interest plus principal to the bank, then fixed deposit. Like in bank, company can also issue fixed deposit. It will get in money from the customer, from an investor, and they will issue an fixed deposit with some interest rate. And then bond and debentures, and then other instrument. So we are going to discuss about bond and debentures. Debt capital means mainly deals about bonds and debentures. Bonds and debentures, the major concept is almost similar, that company will get an amount from the public or investor. That company will issue either bond or debentures. In both the case, company will pay some fixed interest to the investor. But in case of debentures, that it comes under company law, it can be transferable, that ownership can be transferable only by registration, while in bond it's governed by law of contract. It is negotiable instrument. This makes the difference between debentures and bonds. Debentures, it's not negotiable, it can't be freely transferable, while in bond it's negotiable instrument, it can be transferable to any person. Bonds are negotiable promissory note. It is highly liquid in secondary market. In secondary market, that a person can be easily sell the bond to the anyone. So, and then a bond might be sold above or below par value. Par value means that worth of the bond, 1000 rupees bond, 2000 rupees bond, that actual value, face value of the bond. For example, if the bond value is 1000 rupees, if there is more demand, he can sell that bond for 1100. If the bond value is, that bond is less demand, then he can able to sell at 900. So based on demand, that bond value can be traded above or below the par value. And this is the most important point. Market price will approach par value as bond approaches maturity. For example, let's consider this one is 5-year bond. Okay, after 1 year you are trying to sell the bond. If demand is more, you can able to sell at 1100. If demand is very low, 900. Okay, in same bond, 1000 rupees bond, 5 years, you are trying to sell after 4.5 years. In this case, if bond has high demand, you can able to sell at 1010 rupees. If there is no demand, 990. The amount I used here is just for approximately. I used them for approximately. I used them. This is if the bond is sold at 1 year, means we can able to sell at this much difference, but after 4.5 years we can able to sell at, if the demand is more, 1010. If demand is very low, only 990. This difference is, so if you are trying to sell at 4.5 year for 1100, no one will buy your bond. You will say, why I need to buy your bond at 1100? It's very low return to me. Similarly, if anyone asks you for 900 rupees, you won't sell to them. You will say, why I need to sell you at 100 rupees loss? If I hold the bond for further 6 months, I able to sell this bond to 1000 rupees. So as maturity approaches, that market value will be equal to par value. As maturity approaches, that market value will be equal to par value. It will be near to be par value as market approaches, maturity approaches. So next one is the term associated with bonds. First one, face value. That face value is the par value of the bond, 1000 rupees, 2000, 10,000. Then coupon rate. Coupon rate means that interest rate, how much interest that company going to pay. It's a fixed one. Next, maturity. Maturity means that after how many years that bond will be matured. Redemption value, at the time of maturity, what the value will the investor get is known as redemption value. Then market value. Market value is that bond will be sold in secondary market at that time based on demand. At what rate bond is trading is known as market value. Then day count convention, that the interest paid will be calculated based on daily basis. Next, types of bonds. So we are going to see about types of bonds. First one, fixed rate bond. Fixed rate means that coupon rate is fixed, it won't change until it matures. While in floating rate, that it will be linked to some reference rate of interest such as LIBOR. So based on that market value, market raises, interest rate rises, while market reduces, that coupon interest rate also reduces. Then zero coupon bond. Zero coupon bond means that investor won't get any interest periodically. Then what's the benefit of investing in zero coupon bond? In zero coupon bond, for example, if bond face value is 1000 rupees, it will be issued at 900 rupees. So it will be issued at a discount rate. 1000 rupees bond will be issued at 900 rupees at a discount of 100 rupees. So this 100 is known as profit. And then high yield bond, also known as junk bond, which is an below the invest grade. It has a low credit rating. So like junk food, they're saying this one is a junk bond. So, but one benefit is it's very risky one. So they can able to earn high return. There is a concept: the more you take a risk, the more you get return. So it's very risky, so that we can able to earn high yield. Next one, convertible bond. It's an option provided to the bondholder if it desires. At later point, he can able to convert that bond equal to the number of shares. And then inflation index bond. So this is linked to the inflation index, then other index bond. Okay, and then asset backed security. Asset backed security means if a bond they are issuing means those bonds are securitized by some asset. In case a company undergone to a bankruptcy or default, that asset will be liquidated, then the amount will be paid to the investor. So these are the some of the asset backed securities, such as mortgage backed securities, collateralized mortgage obligation, and then collateralized debt obligation. Then we move on to subordinate bond. Subordinate bond at a lower priority than other bond. In case of liquidation, we can able to liquidate but lower priority. Then covered bond is same as the asset backed security, but here that asset security will be remains in the issuer balance sheet. Then perpetual bond. Perpetual bond means that there is no maturity, that interest will be paid every year or every period periodically, that it has no maturities. Then bearer bond. Bearer bond is an official certificate without name. In other words, that paper certificate who has it will be the rightful owner. He can able to redeem the amount. So this type of bond is very risky. In case that bond is lost or stolen by someone, that ownership will be transferred to them. Whoever hold the bond, he will be the entitled to get the cash. Next, government bond is also known as treasury bond. We will know about this. This one is not much risky, it's very safe. Next, optionality in bond. There are two options. One is callability and another one is puttability. For example, company A issues bond for 10 years, but he mentions a line 5-year callability. It means that company A has an rights to get back the bond after 5 years from the issuer by paying them the amount. This is known as callability bond. If it mentions 5-year puttability bond, that investor has a right to force the issuer to repay the money. In case of puttability, actually that bond maturity period is 10 years, but they provide an option. So in case of callability option, that company A can pay back the investor money and get back bond if it desires to do so. In case of puttability, if the investor wants or investor desires, he can give back the bond to the company A and get back his money. So difference between, in case of callability, company has the right. In case of puttability, investor or holder as the right. This is the main difference. It's very important topic, will be asked in exam. So callability means gives issuer right to repay the bond before the maturity date on the call date. That date will be mentioned. Okay, this is also known as call option. All these bonds are also called callable bond. Okay, in case of putability, some bonds gives the holder the right to force the issuer to repay the bond before the maturity date. So put date will be mentioned. This is called put option. So also called as putable bond. In types of bonds, the most important one is zero coupon bond, and then convertible bond, and then asset backed security. So in next video we are going to discuss about valuation of bond. Thank you for watching video. If anyone not yet subscribed our channel, kindly subscribe, bookmark.